In this educational video on Learnify, we will delve into the basics of investing and provide valuable tips and tricks to help you build your financial future. However, it is important to note that this information is for educational and informational purposes only and should not be construed as professional financial advice. Investing entails risks, and one must understand them before making any investment decisions. Investing can seem overwhelming, but it's never too early to start building your financial future. Understand the basics of investing. Before you start investing, it's important to understand the basics. Investing involves putting your money into different assets such as stocks, bonds, or mutual funds, with the goal of earning a return on your investment. When you invest, you're essentially putting your money to work for you, allowing it to grow over time. Step 1. Set your financial goals. The first step to investing is to set your financial goals. Think about what you want to achieve, whether it's saving for a big purchase, building wealth for the long term, or planning for retirement. This will help you determine how much you need to invest and how long you'll need to invest for. Step 2. Start small and be consistent. One of the best ways to start investing is to start small and be consistent. You can start with as little as £25 a month and slowly increase your investment as you become more comfortable. Consistency is key, so make sure to invest on a regular basis. By investing regularly, you'll be able to take advantage of compound interest, which means that your investments will grow over time. Step 3. Choose the right investment options. Choosing the right investment options is crucial to your success as an investor. There are several different types of investments you can choose from, including individual stocks, mutual funds, index funds, or exchange-traded funds, ETFs. Each option has its own risks and benefits, so it's important to do your research before making any investment decisions. Individual stocks. When you buy individual stocks, you're essentially buying a small piece of ownership in a specific company. The value of your investment will be affected by the performance of the company, which can be influenced by factors such as changes in management, market trends, and the company's financial performance. Individual stocks can be risky, as the value of your investment can fluctuate greatly based on the performance of a single company. It's important to diversify your portfolio by investing in stocks from different industries and companies of different sizes. Bonds. Bonds are debt securities issued by corporations or governments. When you buy a bond, you're essentially loaning money to the issuer and receiving interest payments in return. Bonds are generally considered to be less risky than stocks, but they also offer lower returns. The value of your investment will be affected by factors such as changes in interest rates and the creditworthiness of the issuer. Mutual funds. A mutual fund is a collection of stocks and bonds that are managed by a professional fund manager. By investing in a mutual fund, you're essentially pooling your money with other investors to buy a diversified portfolio of investments. Mutual funds can offer a level of diversification that individual investors may not be able to achieve on their own. However, mutual funds typically charge fees, which can eat into your returns. Index funds. An index fund is a type of mutual fund that tracks a specific market index, such as the S&P 500. The S&P 500 is a stock market index that tracks the performance of 500 large publicly traded companies in the United States, including well-known companies like Apple, Amazon, and Microsoft. The S&P 500 is considered to be a good indicator of the overall performance of the US stock market, and is often used as a benchmark for investment funds and other financial products. Other notable global stock market indices include UK's FTSE 100, tracking the top 100 London Stock Exchange companies, and Japan's Nikkei 225, monitoring 225 companies on the Tokyo Stock Exchange. Each index tracks the performance of a specific set of companies in their respective markets, and can be used as a benchmark for investors to measure the performance of their portfolios. By investing in an index fund, you're essentially investing in the entire market, which can help to reduce your overall risk. Index funds are typically low cost and offer a great way to get exposure to the stock market without having to pick individual stocks. However, keep in mind that index funds still carry some level of risk, as they are tied to the overall performance of the market. Exchange-traded funds, ETFs. An exchange-traded fund, ETF, is like a type of investment that works similar to a mutual fund, which is a collection of different investments like stocks and bonds. The difference is that an ETF can be bought and sold on a stock exchange, just like how you can buy and sell individual stocks. ETFs can be a good option for people who want to invest in a variety of things without having to pick individual stocks. This is because ETFs typically contain many different investments, which can help to spread out the risk. Plus, you can buy and sell ETFs throughout the day, unlike mutual funds which can only be bought or sold at the end of the day. Another benefit of ETFs is that they often have lower fees than mutual funds, which can save you money over time. Some ETFs may also focus on specific types of investments, like commodities or real estate. When choosing ETFs or any other investment, it's important to think about your own goals and how much risk you're comfortable with. It's also a good idea to consider any fees or costs associated with the investment. Ultimately, building a diversified portfolio that aligns with your goals and risk tolerance is key to achieving long-term investment success. This means having a mix of different types of investments, like stocks and bonds, to help balance out any potential losses. Step 4. Monitor and adjust your portfolio. Once you've invested your money, it's important to monitor your portfolio and make adjustments as needed. This may involve rebalancing your portfolio to maintain the desired asset allocation, selling investments that are underperforming, or investing more in areas that are performing well. Investing from a young age can help you build long-term wealth and achieve your financial goals. By grasping investing basics, setting goals, starting small, choosing right investments, and monitoring your portfolio, you can succeed as an investor. Remember to do your research, consult a financial advisor, and invest wisely. Thank you for watching. Don't forget to like and subscribe for more informative content. Also, feel free to leave a comment below with any questions or topics you would like us to cover in future videos.